With the RRSP deadline fast approaching here on February 29th, I want to go through some tips and tricks for you, not just up to this deadline, but moving forward. Does an RRSP make sense to you? When does it make sense? And how can you utilize it to build great wealth for your retirement plan? For 2024, the RRSP contribution limit is $30,780. This does not include any carry forward room that you have from previous years. So if you had $100,000 from a previous year that you could carry forward, this $30,000 could be added to it. Again, RRSP contribution is 18% of your earned income up to that maximum of $30,780. So again, if you made $50,000 last year, you would earn $9,000 of additional contribution room. The big question comes in is, does an RRSP make sense for you? And that's really based on a few things. The first thing has to be your income. Typically, RRSPs make sense for higher income earners. The idea of an RRSP is put money into the RRSP while you're in a high tax bracket, take it out at a lower tax bracket. So again, if you make $100,000 this year, depending on what province or territory you're in, you're probably around a 35 to 40% marginal tax rate, meaning that the next dollar that you earn, you're paying around 35% in tax. With an RRSP contribution, you get a tax deduction, meaning that if you put $5,000 into your RRSP, your taxable income goes from $100,000 down to $95,000. So you're saving tax at that marginal rate, the higher rate. Fast forward to retirement, the idea is you're going to pull it out at a lower rate. Hopefully you can income split if you have a spouse or common law partner, but there's a lot more benefit to that RRSP if there's a bit of a flex between current tax rate, much higher than when you're going to be in retirement. And for most of you, that will be the case. You're in a higher tax bracket while you're earning income, and in retirement, you're in a lower tax bracket. There's more tax credits, tax benefits to you, and also income splitting in retirement, which can lower your overall income tax. As a general rule, if you're wondering, well, Adam, I don't know if I'm in a high enough tax bracket. Like, I have a decent income, but is it high enough? And in general terms, it's going to change obviously, but general terms, if you're above about $55,000 to $60,000 of income, an RRSP probably makes sense to do. Some others have written that, if you're in about a 30% marginal tax rate or above, it's going to make sense to do an RRSP. I typically look at, when is that threshold? Look at your tax rates in your province or territory, and when is there a big bump? For most provinces, it's around $55,000. There's a bump from about low 20% to high 28% here in BC. So that's where that big jump is. So look at where the jump is in wherever you live, and that's typically the threshold. So around 55, 60,000, you probably want to look at utilizing an RRSP to some extent to save the taxes now and take that money out at a lower tax rate. Of course, along the way between now and when you take the money out, that money's growing tax deferred as well. So yes, you got to pay tax on the bigger amount down the road, but it's growing tax deferred, saving you from ongoing taxes annually. And again, this is where the combination of an RRSP and a TFSA makes sense in combination. You might be someone that's making an RRSP contribution, but you don't know if it's going to be best to use it for last year. So again, February 29th is the deadline. If you make an RRSP contribution before that deadline, you can use that contribution for last year, 2023. But what happens come tax time and you say, you know what, I made the contribution on February 25th, I can use it for 2023, but guess what, you don't have to. You can carry forward that contribution. So if you made the contribution and as your accountant's doing your taxes, they realize, you know what, you're going to get a big raise next year or whatever it is, you expect your income to increase maybe substantially in the near future, you might be better off using that contribution for future years. So even though you made it now, maybe bump it ahead a year or two. Again, typically it makes sense to use it now unless you know you're going to have a much higher income in the near future. Thus, you can use that RRSP contribution and get the deduction on a much higher marginal tax rate. Another tip with the RRSPs is to look at spousal RRSPs. Now, it doesn't make sense for everybody, but if you're looking to retire early, a lot of the conversation out there with spousal RRSP is, well, if someone's in a higher tax bracket and earned income years and the other person's not working at all, then do the spousal RRSP. But the reality is if you retire at 65 or onward, you can split RIF income or RRSP income anyway. So it doesn't make a difference. Where it matters is if you plan to retire before 65 and the majority of your taxable income is going to be coming from an RRSP, then you want to consider using a spousal RRSP as well. Because let's say you just build up an RSP. So let's say Jim and Sally, and Jim's working and he builds up his RSP, but Sally's not working and never does. They retire at 60 and their only assets they've built up are their RRSP. And it's all in Jim's name. So they're going to convert that to a RRIF and start drawing it out. But again, all that income is going to be taxed to Jim. He cannot income split that RRIF income until age 65. So if you're thinking about retiring early, if Jim had put half of his RSP in his and half in a spousal RSP, come age 60, they could draw that out and split that income properly. So again, there's some attribution rules there. You have to not contribute for 3 years. So there's a bit of tax planning there. So work with your financial planner. But the spousal RSP can be a really great tool. Remember, when Jim contributes to the spousal RSP for Sally, he gets the tax break. It's his RRSP contribution room, and he gets the tax deduction on that. That's really important. A lot of you get lost in this. So let's say Jim makes that $100,000 a year and he wants to put $10,000 to the RSP, but split it. He'll put $5,000 to his RSP and $5,000 into the spousal RSP. That spousal RSP is in Sally's name. She owns the account. He's the contributor. He's going to get the contribution for that, so he's going to get the tax deduction. He also is the one that needs to have the contribution room. Has nothing to do with Sally's contribution room. So keep that in mind when you look at RSPs and contributing to a spousal RSP. A few of you have asked about RRSP loans over the years, and I'm not a huge proponent of it. They used to be very popular back in the 90s and 2000s, but when I got in the business, everyone did an RRSP loan. It's kind of tailed off. I see the odd one come through. Again, I would say you're playing catch up. So if it's your very last year and you it makes sense to borrow a bunch of money to do an RRSP because you're not going to have income down the road, maybe it might make sense. Again, walk through that with your financial planner. But in general terms, I prefer to say, skip a year, because RRSP loan is your borrowing money, you're paying interest on that, and you're paying it back over time. So you're always playing catch up. Maybe it's better to just skip a year, start contributing instead of paying off the loan, just contribute and use that for the future. I get it, you're not gonna have the deduction for 1 year, but you're not playing catch up anymore. You're actually using your own money to contribute to your savings plan. Might be a better idea. Again, everyone's got their own opinion on that. That's my opinion. Once you've made your contribution to your RRSP, one thing that a lot of you forget is you need to invest that money. And whatever you invest in doesn't matter to me. But a lot of you are leaving that money in cash. It's doing nothing for you. And you've put money into your RRSP, you're getting the tax deduction, but that money's not working for you. So don't forget, when you put your money into the RRSP, to get it working for you. Whatever that looks like, that's up to you. But make sure to get it working for you. A few final tips around RRSPs are make sure to maximize employer matching. A lot of you work for companies where there's a matching opportunity from the employer. That is a free raise for you. And so many of you are not taking advantage of that. So if your employer matches, let's say a percentage amount, 5% of your income, or maybe $100 a paycheck, whatever that is, make sure to take advantage of that full matching. Find a way to do it. That's free money. We all want to earn more money, yet a lot of you are leaving that on the table. This time of year, a lot of you are getting bonuses as well, or maybe it was year end. As you come up to your bonus, whenever that is throughout the year, ask if you can put that into your RRSP right away. So instead of collecting, say, a $10,000 bonus, 30% taxes withheld, you're only left with $7,000, you're not sure what to do with it, you end up blowing it on a trip, not really helping you. You could take that full $10,000, roll it into an RRSP, get that money working for you, save the taxes up front, defer it down the road when your income is going to be lower. That can be hugely beneficial. And I'll say this, our clients that did that over their career have built up much more wealth than everyone else that burned it on whatever they burned it on. Now, the last tip I have for you is really around the RRSP refund. When you make a contribution to your RRSP, your tax refund should come to you. And thus, you have a chunk of money. Put that to work. That could be put back in, roll back into an RRSP, or what I like to do is roll it into my TFSA account. So if you haven't already maxed out your tax-free savings account for the year, put $10,000 into RRSP, $1,000, whatever that number is that you can afford. Whatever you get back from your tax refund, that's not free money. That is tax money that CRA has been holding on your behalf. A lot of you get a tax refund and you think, wow, this is bonus money. No, this is your money that CRA has been holding on to. They're just giving it back to you. Make sure you use that for an RRSP, a TFSA, whatever it is. It's not free money. Trust me, CRA never gives you free money. That'll never happen in your life. I can promise you that. This is your money coming back to you. Don't treat it like free money. It's hard-earned money that you worked for. make sure you continue to let that money work for you going forward. Again, throw it back in RSP and keep compounding that into there, or throw it into the TFSA. Again, sit with your financial planner, figure out what the best plan is for you. Thanks for joining us in this video. If you're not already subscribed to the channel, hit the subscribe button, join our channel. We do 2 brand new videos every week around retirement planning in Canada, retirement tax, and estate planning. Thanks.